the life insurance for the living. So many times we're sitting with a client and they are doing the first meeting, the discovery meeting, and during that meeting, the question of life insurance comes up. Whether they have it beneficiary right, whether they have the right amount, whether they even still have any. And a lot of questions get brought up in that first introductory meeting on life insurance, mostly because everybody knows that they should have life insurance, but what we find out is very large number of people, over 50%, do not have life insurance. And so it brings it top of mind. Sometimes we can go down one of three trails. We can go down the garbage pail, meaning this is an off-profile client, there's nothing for us to discuss further, or they're not open to discussing it further. That doesn't happen very often out of the discovery meeting. Or we have a planning trail where they just sort of say, boy, it's time for a comprehensive review. Or we sometimes have a data sale, and if that data sale is life insurance, why not get right into it in that 30-minute meeting and take an extra 15 minutes after you've asked permission with the client to go ahead and program out the life insurance need so that you can prepare for the next meeting. And they can be preparing their budget for the next meeting. So that's one way that I would go towards a data sale out of the initial meeting. If there's a planning trail, I'm going to still do this, but I'm going to do it in the second meeting. I'm going to do it in the fact-finding meeting. And you can do it any way you want. This can actually happen in either meeting. So if for some reason there is a need for life insurance, whether it's discussed as a priority or at the bottom of the page about life insurance it says they need assistance, I go to this tool. It's a brochure found on Market on Demand. Many of your offices probably have some on hand, but I've got the number right there on the email to you this week. So I don't start with the income continuation as the brochure would indicate. Instead, I don't know if you have the script I sent out, but I like to start with the mortgage fund. And the reason I do that, it's probably the most soft way to start. I think most people know they need a mortgage fund, and it's the reason that most people get life insurance is to pay for the mortgage if someone is gone. I don't start with the warm-up on the sales track. I don't actually like it very much. It's very cheesy, and I feel cheesy saying it. So I would start where it says identifying needs and analysis. So what I would say to the people is I would say, let's move forward in programming out some life insurance so I can do a little homework and get some ideas for you, since that seems to be an area of interest. So then I would say, there's 4 main areas that we'll discuss, and I have a little brochure for you. I typically lay one of these facing the couple or the person, and one of these laying me, and I give them a pen. Because what I want to do is I want them to take home the filled out analysis, and then I will take it with me as well. And it's very interactive, and it gets them to feel that they are programming out their life insurance. So I start with this. I'd like to begin with the mortgage fund because I believe it's the most important thing we can do, is to make sure your loved ones will remain in their home as long as they choose. Would you agree that's important as well? It's really good to get them talking. It gets them from getting too bored. It gets them engaged. So let them say what they feel. Okay? Don't overlook the conversation if someone is renting. Just say, I'd like to begin with the rent fund because I believe it's an important thing that we can do is to make sure our loved ones remain in their home as well. Would you agree? So then I will say to them, what is your current mortgage? Okay, so you have a current mortgage of $200,000 left on your mortgage. So let's put down $200,000. Would you agree that's the amount you would like to allocate? I get them to say what amount they want. From there, we go down to immediate cash needs for liabilities. In addition to the mortgage, all estates have settlement costs, including those costs that are things like final medical bills, final taxes due, short-term debt, like car loans, school loans, credit card bills. What amount would you need to pay off your debt? And then I ask them that, and they start to add up. You know, we owe $5,000 on the car, you know, $6,000 on the boat, and, you know, we have that credit card bill with Visa, and let them come up with a number. Then say, okay, then let's put that down. They put it down, you put it down. Then I go on to the emergency fund. And the emergency fund, I frame up a little different than the script, and you can do it whichever way you want. No perfect way, I don't think. So I typically say on the emergency fund, on the emergency reserve fund, I say most people would like to have 3 to 6 months income on reserve at all times. Do you currently have that? And they say no. Okay, well, so if something happens to one of you, there's a really good chance that the other one is gonna need 3 to 6 months in time to settle things. Whether it be to help with the kids, whether it be to settle the affairs, or whether it be to just grieve. So I call this our permission to grieve fund. And I've seen this with people, there's a lot, it's very overwhelming when you lose a loved one for many reasons. So would you want the income that you both make coming in for the next 6 months so that there's no rush to get back to work? And then most of them say yes. So then I just say, what is your average monthly income between the two of you? If they say that together they make $5,000, I say, do we want it for 3 months or 6 months? And I give them that choice. Most of the time they'll say 6 months. So $30,000 in a permission to grieve fund or an emergency reserve fund, as it may be. And then we move on to other expenses. Typically there are some final expenses and the costs that funerals, estate planning, probate costs, lawyers, etc. Most people are finding it's greater of $15,000 to $25,000. What number would the two of you, or would you, be comfortable in? And I give them a range for a reason, because typically they'll choose the middle number of the range. If I say 15 to 25,000, almost everyone will say 20,000. Human nature. Okay? Then we total up that column. From there, I go to the left. I go to the left and I say, okay, let's go back to this income continuation. As you go back to the income continuation, what do you typically bring in? The two of you, we said $5,000. Okay? So, Mr. Prospect, how much of that is yours? And Mrs. Prospect, how much of it is yours? And what I do is I draw a line right down the center here, and I put his amount on one side and hers on the other. If the total they need is $5,000 and she makes $3,000 and he makes $2,000, then if she's gone, he needs an extra $3,000. Now, I typically ask if they'd like to allow for Social Security, if they believe that that will continue to be a factor, and they want to rely on that. Most people will tell me no. They do not want to rely on Social Security. So at that point, I will say, so Mr. Prospect, you'll be missing $3,000 a month if she's gone. So let's go down to our chart. You have small children under the age of 2. Do you want to allow that income to continue until those children are gone, which, you know, I'm still waiting and mine are in their 20s? Or do you want to have that go until your spouse, till you are 65 and retired? And everybody chooses their own, whether it's 20 years or 30 years, but I put it out here and I go 3,000, so 456,000 would get you through raising your children. Would that be adequate? And then if that's true, then I go down here and I have them put that in their box, and they interactively fill that in, and so do I. Okay, so we've got 300,000, 200,000, and probably another 50,000 here, maybe even more. Okay, then I go over to college funding. We all know that the cost of college is going up, you know, and look at this. This shows that public schools are costing about $76,000, which I would say is right. My kids have just gone through college, and you'd be lucky to get out for $76,000. But in 10 to 15 years, when your children are going, it's gonna be closer to 100,000. Have you ever had a discussion about what portion, if any, you would like to cover of your kid's college education? Well, you know, we'll save what we can. You know, typically people are saying, I wanna pay a portion of it, but I want them to earn it. So then I say to them, okay, well, if something happens to you prior to them going to college and you having saved that fund, would you like it to be self-completing? Would you like a self-completing college fund if you pass away? Meaning that we will allow for that in the life insurance to cover the amount that you wanted to set aside for your children. And some people will really stall here. I've had a lot of experiences here where people know, if I pass away, then that's just the way it's gonna be. Or I have people say, you know, let's put something in there, but I don't expect to cover it all. So maybe they'll put 100,000 in there for their 3 children to split. Meaning that, you know, it won't cover everything for college, but it'll cover a lot of what they need in the beginning. Okay? Any questions so far? Now we have all the blanks filled.
I just had a comment, Becky.
Yep.
When you have somebody say to you that, when you ask that Social Security question, no, I'm not really counting on that, how do you respond to that?
I say that I believe, and from what I've read, I believe that Social Security will still be enforced, but what I'm understanding is that it will look different to 20 years from now than it does today. I don't know exactly the difference, but I suspect that maybe it will start later and maybe the amount will be lower. But I don't suspect that it'll be gone altogether. So I don't try to put the fear of God in them about Social Security, but I do tell them, excuse me, I do tell them that I suspect that it'll look different.
Yeah, I think that's certainly, as this entire thing is, as you go through the process here, hopefully this is a conversation where it's not you just plug and play and it's pretty black and white, but that would be someplace that I would, you know, probably really stop and say, really, well, you must have some reason you feel that way, may I ask what it is? And kind of talk a little bit about some of the talking points, especially, I would, that would, when somebody told me, wow, no, I'm not counting on Social Security, really? Okay, well, tell me more here. I think I want to get into and see how informed the consumer is, and really what they're thinking, and so on. You know, again, if I'm dealing with somebody in the next 20 years, I think you're exactly right. We may have some changes, but I just don't see Social Security going away. I want to know what they're thinking, and that's a pretty, when you do the calculation on it, I mean, when you start talking husband and wife, you're looking at anywhere from you know, $4,000 to $6,000 reoccurring revenue on an annual basis, or you know, on a monthly basis. That's a pretty big portion of the calculation that they're doing here. So I think that's a pretty important part of whether it's right here in the life insurance or some of the planning you're doing for them later. You better have that conversation sometime with them.
True, and to be honest, I do usually at that point stall during the Social Security. I hope you can all hear John. I do stall during the Social Security conversation and make them aware of how that works. That as long as the children are in the household, that the spouse will receive a Social Security check for themselves and each of the children, and then as each child goes away, they will lose a portion of that until the last child is out of the house. Once the last child is 18, there'll be what is called a blackout period. There'll be no Social Security coming in until they turn 60. And I also make them aware of the fact that their income will be the income they earn. If I suspect that they earn over 50,000, which I should know kind of just by their thing, if they earn over 50,000, then they're going to have to watch how much they earn, or they'll lose that Social Security benefit as well. So if it's somebody who makes $100,000, hello?
There's a cough.
Oh, anyway, if somebody makes $100,000 and their spouse makes $100,000, you know, the Social Security is going to be pretty irrelevant. If they both make $25,000, it's going to be very relevant. So, you know, I kind of take that into account. No one's going to give up a career as a doctor, you know, for their social security check, probably. So you just kind of got to look at that and know that. And if you have questions on that, I can answer that later, but that is a good point that John brought up. So you have to plug in the numbers over here with the client. And then comes up the question of, do they have any existing insurance? And this is where some education is going to take place, because they're going to bring up that they have some at work, and I don't know how much I have, and you know, I think I have 100,000 at work, and do you have 100,000 on me too, honey? And then, you know, they're going to really start to question what they have. I don't care so much to find out every detail right now. I'm going to have them bring that to the next meeting. I'm going to have them bring all of their policies for review and all of their statements. And I'm going to get an idea of how much existing coverage they each have. And again, I'm going to draw a line down the middle of this column too. One for the husband, one for the wife, because they're not likely to be equal. And I do discuss other assets, if they have a savings account or CDs. But I also warn them that the last thing we want to do upon this passing of a spouse, is to spend the retirement fund. Because they still will retire, they still do need that money in retirement. And so the last thing we want to do is start liquidating our savings that is in place for retirement in order to cover the needs that we've discussed over here. And then I talk about what we're going to need, and I talk about the different types of life insurance. I'll talk about term versus perm, and I'll say that the one good thing is with term is it's great for some temporary needs. It's very inexpensive. However, it does run out at some point. With Mutual of Omaha, our term is convertible. You can change it into a permanent policy. However, it will be based on your new age. So if 20 years from now you try to buy it, it will obviously be quite a bit more expensive than if you bought it today. And if we run the numbers against each other, buying it today would have been cheaper than waiting and converting it. And then I'll talk about permanent insurance, and I'll talk about the return of premium, I'll talk about the cash value, but I keep it pretty high level for this meeting. Okay, so now I send them home with some homework. I'm gonna walk them through bringing me back everything in that financial overview. And the reason I do that is because I really want a clear picture before I recommendation about what is their lifestyle. I talk about their budget being their lifestyle. Show me a picture of your lifestyle by giving me your budget, making sure that it reflects what we need in place. And then also, it also helps us to understand where the difference is between what they've got coming in and what they've got going out. Okay? So that is where I leave it for that first meeting. Then when I come back for the second meeting, one, I've run some proposals. I've got some ideas. I might show them 2 or 3 options. But I'm also going to first look at that second meeting at their budget. I'm going to have conversations with them about, I bet you've had some discussions since we met last. Tell me about some of your thoughts. Because they're going to come back with a whole different idea, because they walked out of there a little shocked that they needed $500,000 of life insurance or $1.5 million, and they're going to come back with an idea of maybe just a little less than that would be fine. So we have to come back with that, come back and start the conversation with them revealing what they're thinking and talking about, and then we can go from there. If you don't get into this in the first meeting and you get into the fact finder, I pull this out of the Navigator fact finder and I have this brochure just slid in there during the life insurance section. And I can get into it that way. This is a great tool for programming out life insurance and having an interactive conversation with the client. This conversation is not going to go as quick as mine did here today, because there's going to be a lot of discussion, and you have to get him and her, if there's 2 of them, to agree. Does that make sense? And what questions do we have? I'm opening up the lines. Questions in here? Have you guys seen this before? Done it before? Is it pretty comfortable? So. Pretty comfortable? Okay, so it might be a review. Go ahead.
No question here, Monica.
Okay, is that something you guys are using pretty frequently on